Hello, friends. Welcome to the Weekend Investing Daily Bite of 16th of October. And the market remains in a limbo. Again, not able to, garner support at the previous days, falling a bit. So there seems to be a complete lethargy in terms of trying to go up. And while it is difficult to read what is exactly going to happen, but there is a chance of the down move on the head and shoulders pattern now. That remains very open. There are a lot of course, people who are talking about a big crack in the market. So let's look at what has been the past history of big cracks, scary scenarios. Of course, I'm not trying to instill any fear in you. We will follow our set path of investing. But can a dot-com like scene happen? We'll try to analyze that today in the episode. Please first read the disclaimer. It's very important for your safety as well. So the markets today, uh, as you can see, Nifty today is the sixth or seventh session where we have just dilly-dallied around the 25,000 mark, going up a few 100 points, coming down something, but not really going anywhere. And this, as I've been mentioning, the left shoulder and the head is ready, and the right shoulder can happen in one day. And if that happens, we are certainly going down much further. So Nifty at minus 0.34%, I would say, is kind of precariously poised. Uh, Above 25 to 67, this average here is where I will start to feel comfortable about Nifty. Till then, this is sort of skating on thin ice, if you may say so. Um, Nifty in Junior down 0.21%, but still looking slightly better than Nifty on that front, slightly above the average, not near these bottom pivots. So Nifty Junior looks better than the Nifty. Nifty mid cap is reasonably all right, I would say, nearly about 22,000, 0.2% down today, but I would think that's okay. Small caps as of yesterday also is gaining 0.21%. So small caps is sort of bucking the trend, which large caps. So FIIs continue to sell and domestic investors continue to buy, and that's what is getting reflected in the indices also. Bank Nifty also tried to capture the moving average again, but failed, uh, down 0.2% from yesterday, but not really dropping very hard as such. So Nifty is the only sort of index which is sort of in a gray zone as of now. In terms of advanced decline, you almost had equal advanced decline, 235 advances to 262 decline, so not too much of a shift towards the red. The good news, perhaps, if we want to look for it, is that F5 outflow for the previous session was lower, much lower than all the previous sessions put together, or on the average, minus 1700 crores, and DII is, of course, absorbed all that sales in that front. Heat map largely red. So Mahindra and Mahindra, Trent, these are some of the stronger players of the previous few weeks. They have been clobbered today. Infosys down 2%. ICICI Bank after yesterday's run down nearly 1%. HDFC Bank pulling up 1%. HDFC Life after a big manager has moved out of the stock is moving up 1.76%. Reliance is up 0.75%. So you had a mixed bag. No great casualties, but of course, no great trend together as well. Nifty Next 50 also is a mixed bag. You have ICICI Pruli, Adani and Sol, HAL moving up, and essentially Motherson, Zomato, Zydus, LTIM, Bajaj Holding, these stocks were moving down. Mixed bag again, DLF up, DMart flat, TVS Motors down 2%. Sectoral trends, real estate, some more gains building on top of yesterday's gain at 0.6% today. 1 week gain is now top sector for this week, 3.1% for this sector. Others were all muted except, you can say, IT and auto, losing 1.2 and 1.3% for the day. The other sectors, banking especially, were completely flat. Pharma was flat, FMCG flat, energy flat, and so on and so forth. So market is sort of looking for direction, where to go. Autos minus 1.27%, not really going anywhere. We are in this zone of 25,000 to 26,000, stuck here, all down equally, between 1 and 2.5%. Stock spotlight is on Aditya Birla Sun Life. AMC is shooting up 11.5%. So all this consolidation of the last month recovered in one session completely. And if you see the longer picture, this stock has been very, very rapidly and soundly moving up from nearly 300 rupees level to 779. So look for dips and look for entry opportunities in the stock if you are a discretionary investor. So the discussion today is coming back to the potential scenario of either a scare or a dot-com like crash like scenario. So let's see what S&P 500 did in the past. What are the stark similarities of the past peak? So you can see that in year 2000 on the dot-com peak, uh, you had a reasonably large collapse going from nearly 1600 S&P index to nearly 800 and or roughly about 800 on that. So about 50% was lost here. COVID fall, in fact, was not so bad if when compared to the January 2000 dot-com bust, or even the 2008 crisis was similar to the dot-com crash here. Uh, Households allocating only 15% to cash versus 48% to equity. So in terms of amount of household money going towards equity, that really picked up very big time, going from 10-15% to nearly 48% in 2000, and the market correct. And then again, it has now come back to sort of similar levels where equity exposure for at least you can say US households is now back at where it was in year 2000. That itself may not be a reason enough for markets to crack, but the fact is that once we did that in year 2000, we had a lull on S&P 500 for almost 12 to 13 years. There was a crack, we came back up, then there was a crack again, and then we came back up, and this cycle took 13 years for it to complete. And then, of course, we went another 3-4x. So this point that we had achieved when household equity was at a reasonably high level uh, was one of the indicators of overly, households being overly exposed to equity or overly overbought in equity at that point of time. In 2020 also, when equity allocation went to that kind of highs, there was a very sharp correction, 32% correction on the S&P 500. And euphoria was at an all-time high, which currently also you can say that, it is a sort of a Goldilocks scenario. Nobody is able to pinpoint, what could go wrong. Every analyst comes on the TV or in publications says that every market is very expensive, but how things will pan out is something that nobody can really forecast. So the only history lesson that we can learn is that whenever people become overconfident on the markets, whenever people are overbought on the markets, there may be some event that may happen which may bring down that euphoria to normal levels, and then it can build back up again. So if we were to sort of uh, see that point of view, then we are somewhat in that kind of scenario where we've sort of gone into a blind confidence that market has to keep going up. That is never a good sign, although you can say that we felt the same at 20,000, we felt the same at 22,000 in Nifty, we are feeling the same at 25,000. Who knows, this may carry on till 30,000, 35,000. We really can't say. So from an absolute perspective of what is that number, I think that is futile to call. That is no way, nobody can really call it. Some people will obviously be right. If 100 people will say that this is the point from which market will fall, few of them are going to be right just by chance. But you really can't call it because the money base in the world is continuously going up. So there is no absolute value that you can ascribe to anything. If 20 times price earnings was good enough 20 years back, the same maybe 50 times now. And there is no real way of measuring what should be the value because everything is up. All markets are up, all asset classes are up. So there's only sort of subjective sort of evaluation that you can do, that yes, everybody around me is talking about equity, hence equity may be extremely overbought, overhot, so on and so forth. But in terms of what needs to be done, there are only two things that need to be done: stay invested and stay diversified. So stay invested meaning don't jump and sell your house and buy equity now. Keep gradually chipping at it, keep gradually bringing in money, keep sipping or keep doing invest more every 3 months. That is fine. But don't think that if you have missed the rally so far, that you are going to sell some big chunk of your other asset and now bring it into the markets. I think that is is danger zone for that right now. You don't want to come in with your liquidity into the market, especially when the markets have done a great amount of run up in the last 18 months. There is always a higher chance of the market doing something that you don't want it to do. So gradually keep coming in. What that gradual entry will do is that even if markets were to dip and you are gradually bringing in money, you will gradually enter the market at every level. And once you will surpass 3 4 5 years and look back at that time period, that yes, markets were high then also and I was gradually bringing in the money, it really did not make any difference. So if you were at 2008 peak right now, or if you were at COVID peak right now, and if you were to gradually bring in money, if you can just go back and see what would have happened if you started to invest even pre-COVID levels, or if you were bringing in money pre-COVID levels gradually, what would have been the outcome today? So you always need to see the outcome many years hence and not immediately. So market going down is no concern really. I mean, I know for sure if the markets crack because of global reasons, Indian market will come back up because we are inherently growing very strongly. So the asset allocation part of it, that you are keeping your eggs diversified beyond equity also, and within equity you have exposure to large cap, mid cap and small cap. If you're doing these two things and gradually bringing in your money, I think there is no need to be fearful. And there is no need to do any forecasting. Just blindly, like in a military like fashion, keep doing this, as if you are a machine, and you will find in 5 years time you will be doing very well in that. So given this scenario, given where we are, given how all asset classes are going up, do mention in the comments how you are seeing the markets. What are you strategizing? How are you? Because a lot of people who interact with me keep telling me, I've taken this, I'm sitting on cash. When will I deploy it? Should I take out 50% cash? Should I partially sell? So it will always depend upon what is your comfort level. If you are not feeling comfortable, take something out. No worries about it. Even if you are invested 70% and 30% in sitting in cash, it is fine. I mean, as long as you are having a great sleep at night, how does it matter? So don't be in a race. See what is comfortable for you. Have asset allocation, have diversification, and follow a plan where even if something were to go wrong, you will be able to build back up. That should be the real key to your success in the market. Thank you so much for watching. I'll see you the next time. Bye.